Hi, I'm Linda Eedes from Foord Asset Management, and I'm joined today by Rashaad Tayob, who is a macro strategist and portfolio manager here at Foord. So today we're going to be talking about a useful framework that we use to consider macroeconomic risk and to understand where we are with regards to the macro environment. So we call it M.I.C.E, and Rashaad, of course, that refers to M for money for the markets, I for interest rates, C for confidence, and E for earnings. So let's start with M, money for the markets. Now that's about how much liquidity there is to buy into the markets. What do we use to measure this, and where are we right now?
So Linda, since the financial crisis of 2008, the biggest driver of money for the markets has been the global central banks. And they've injected massive amounts of liquidity into the market by buying up bonds and expanding their balance sheets. And given that the dollar is the global reserve asset, the actions of the Federal Reserve, the US Fed, is the biggest driver in terms of money for the markets at the moment. Now, the Fed increased its balance sheets from $4 trillion up to $9 trillion during the COVID crisis. And since August of this year, they have a plan to reduce their balance sheets by $95 billion a month. So that's a run rate of over $1 trillion a year. And they're following through with that plan. And while they're following through with it, there is a massive headwind for risk assets as liquidity is being withdrawn. So money for the markets negative at this point.
Okay, so let's turn to interest rates. And of course, interest rates are a very strong driver of markets. Where are we in the interest rate cycle, and what does that mean for our temperature gauge of the markets?
Yeah, so interest rates have gone up a lot, and they've gone up very quickly. So the Fed has moved from 0% to 3% in just over 6 months. The ECB, the European Central Bank, had negative rates for about 10 years, and they've moved from minus 0.5 to plus 0.75. And in South Africa, we've moved from 3.5% to over 6%, and with more to come. So interest rates have gone up a lot, but importantly, credit spreads have also gone up a lot. And you're in a situation where the cost of funding for companies has increased. So where companies had gotten used to funding at very low rates, maybe 3-4% in dollars, they're now issuing bonds at 8-9-10%. And with these higher levels of interest rates, that's a massive headwind for the market as well. So interest rates, another negative.
So we get to the third factor, which is C for confidence. Now, the previous factors we've spoken about are more about whether companies and businesses are able to invest and spend and borrow. C is more about whether they're willing to spend and invest and borrow. What do we look at to measure that? And where are we with regards to that specific factor right now?
So with everything that's happening at the moment, geopolitical risk, spiking energy prices, and the headwind of interest rates, it's no surprise that companies and investors are actually quite negative. In fact, if we look at a Bank of America survey, which looks at the amount of the fund managers which are bearish versus bullish, we find that there's more fund managers who are bearish than the bottom of the market in 2008. Because confidence is at such a low level, if it does turn around, this will be very positive for the markets.
So let's talk about the last factor that we consider in M.I.C.E. So E is for earnings. And this is about the prospect for earnings. So of course, that must be with regards to considering some of the headwinds potentially, and also where we are in the earnings cycle. So let's take a look at that factor specifically.
So if we look at earnings globally, our assessment is that earnings are 20 to 30% above their trend levels. And why is that? It's because there's been massive amount of stimulus since the pandemic. Governments have funded the consumer, they've been able to spend, and therefore earnings from companies has been positive. But a lot of that stimulus is being pulled back. So going forward with earnings 20 to 30% above trend, we expect some sort of reversion, and that's going to be a headwind for the market going forward.
So Rashaad, we've got 3 out of the 4 factors that we consider in the M.I.C.E framework that are not looking so great right now. Putting that all together, how does that look in terms of our positioning right now?
So with 3 of the 4 M.I.C.E factors being negative, it's no surprise that we are cautiously positioned and focused on the capital preservation aspect of our mandate. However, we have to be aware that the money for the markets and interest rate factors can turn quite quickly. Interest rates have gone up sharply and much more is being priced in. And in terms of money for the markets, central banks have plans to reduce their balance sheet. But what we saw last week was the Bank of England moved from reducing its balance sheet to increasing its balance sheet within a very short space of time. So that can turn quite quickly. And if it does, it will be a strong boost for the market, which we are ready for.
Right, so we're still cautious and we're still managing some of the risks given all the things that you've outlined. But there are opportunities that are presenting themselves, of course, given that markets have already fallen by the extent that they have. So across our multi-asset funds, we do actually have quite high equity allocations already. So I think we feel confident that we are positioned for the recovery that will eventually follow. Thanks, Rashaad, for your contribution to today's discussion, and thank you everyone for joining us.